Hi friends, welcome back to Mukti Finance Academy. Today, the third company which we are going to discuss from auto ancillary space is none other than Lumax Industries, which is a affiliate or subsidiary or sister entity of Lumax Auto, which we have already discussed just now. So if you haven't watched that video, please do watch, which is already live on the channel. But before we start, a quick disclaimer: I am not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. Please do not consider it as a buy or sell recommendations. So the Lumax Industries isn't just selling lights. They have locked India's top OEMs with technical marriage through 40-year-old JVs with Stanley Electric Japan and SL Corporation South Korea. In an industry where speed to market is the only currency that matters, these partnerships acts as a formidable barrier. So Lumax essentially localizes the global R&D, making them the default choice for OEMs, moving from simple illumination to complex electronic phases. Coming to its revenue mix for Q3 fiscal year 2026, the company generated nearly 65% of its revenue from passenger vehicles, 29% of revenue from two-wheelers, and 6% from commercial vehicles or three-wheelers, and 69% of revenue again from front products and 22% from rear products. Like front products, I mean complex electronics and night vision, and rear is nothing but animated tail lamps. And in passenger vehicles, the company offers high value LED headlamps and DRS. For two wheelers, it offers LED conversions and main headlamps. And for commercial vehicles and three wheelers, it offers auxiliary and commercial lighting. So the legacy relationship provide the stability, but the Stanley and SLJVs provide the tech. By integrating electronics and HVAC panels, Lumax is pivoting from a hardware shop to a electronics tier one. This isn't just a business model, it's a structural moat that forces competitors to play a permanent game of catch up. So the Indian auto sector has moved past the functional era. Lightning is now the primary differentiator of brand identity. The shift from halogen to LED isn't just about brightness, it's about the kit value explosion. So the shift from halogen to LED isn't just about brightness, it's the kit value explosion. A basic halogen amp is a commodity, and an adaptive driving beam ADB or a 20,000 pixel projector module is a high margin electronic system. So market volumes are currently supported across all cylinders per SIAM Q3 data. So with passenger vehicles plus 19%, and two-wheeler with 15% and three-wheelers 35% and commercial vehicles at 18% impressive growth. So furthermore, the government's 40,000 crore outlay for electronics manufacturing and PLI auto schemes are subsidizing the very localization Lomax needs. So we are witnessing a 5 to 6 times content per vehicle jump as we move toward the technological roadmap of slimline modules and road projections. LED penetration in Lumax revenue hit nearly 61% this quarter, previously at around 52%. But the real margin story lies in the upcoming night vision and ADAS sensor integration, ADAS. So, in the ancillary world, proximity is destiny. Lumax 29 plants ensure they are the next door neighbor to every major OEM hub. This physical presence allowed them to execute the Tata Punch facelift project at exceptional speed, a critical KPI when vehicle life cycles have shrunk from 5 years to barely 2 years. So, in recent order wins, it also supplied its parts to Sierra, like fog lamps and tail lamps, and for Punch facelift also it provided DRLs, and for Mahindra it provided last mile mobility e-rickshaws. For TVS, it secured the flagship Apache RTX300 headlamp order also. So execution speed builds valid share. When an OEM like Tata needs a rapid refresh to keep a model relevant, they go to the supplier that can move from concept to SOP, start of production, the fastest. Lumax agility is directly translating into a bigger slice of OEM pie. So for Q3 fiscal year 2026, it looks like a breakout quarter on the surface with a headline EBITDA margin of 10.6%. However, the sophisticated analysis must strip away the noise. So the company's operating revenue for Q3 fiscal year 2026 stands at 1,053 crores, which is an 18.7% year-on-year growth. And EBITDA also it jumped by 57.3%, reaching to 112 crores. And EBITDA margin also saw a 260 basis points jump, reaching to 10.6% previously from 8%. And its net profit also grew by 39%, reaching to 47 crores from 33 crores. So strip away those 10 crores extraordinary tooling profit versus the usual INR 5 crores. The clean EBITDA stands at nearly 9.7%, still a record, but not the double-digit headline. So the company is also having a non-operating income plummeted from 18 crores to just 1 crore this quarter. This masked the true strength of the operating beat. And PAT was also dragged down by a non-recurring 15.9 crores hit from new labor code implementation. So the core manufacturing business is roaring with 35.8% growth, while the 10.6% margin had a tooling booster. The underlying 9.7 margin is a solid foundation. The PAT looks may only because of the labor hit and the collapse of other income. Don't let the bottom line distract you from the operating excellence. And coming to its KPIs, KPIs are the vital signs of this business. The most important metric isn't today's revenue, but the profile of the future revenue. Currently, its order book stands at nearly 1759 crores, and LED mix current is around 61%, and order book is around LED mix is around 81%. And asset turnover is also improving as capacity utilization tightens. So the 81% LED based order book is the bridge to management's 20% growth guidance for fiscal year 2027. It provides high revenue visibility and built-in margin protection as higher electronics content typically yields better absolute realizations. So management also raised its fiscal year 2026 capex guidance from 220 to 260 crores to 350 to 400 crores. In most cases, a 50% jump in capex is a red flag for cost overruns. Here, it appears to be a bullish bet. So management claims this preloading advancing capital for long lead time machines for Bengaluru plant, wherein it provides its products to Maruti and Toyota, and Chakan phase 2, which is about to serve for Skoda and Volkswagen. They are essentially spending now ensure they don't miss the revenue bus in fiscal year 2027. So Lumax has a high say to do ratio on operational execution, but the capex jump is aggressive. They are betting the farm on 20% plus growth in fiscal year 2027. If the Bengaluru plant hits SOP on time by Q4 fiscal year 2027, this will look like a genius. If demand falters, it's a lot of idle steel. So coming to valuation, Lumax has historically been the cheap lighting play because of single digit margins. With margins normalizing, the gap is closing. So currently Lumax is trading at around nearly 30 PE with EBITDA, EV to EBITDA of 17.3 times and ROC of 16.4%, whereas its quarter profit variance is around 75%. So coming to its competitors, it is definitely trading at a lower PE. So Lumax profit variance is the highest among its peers. At 30 times PE, the market is still pricing Lumax as a legacy hardware player, ignoring its pivot to an 81% LED order book. This is a classic re-rating candidate. So the stock is fairly valued based on history, but cheap based on trajectory. If they sustain a 10% clean margin, the valuation gap with Unominda is unjustifiable. The 30 times PE is a reasonable entry for a market leader growing profits at 75% year on year. So what are some key red flags in this company? Are its customer concentration. Maruti Suzuki is alone contributing one third of the order book. If Maruti sneezes, Lumax catches a cold. And import trap. Localization is only at 30 to 35% for electronics. LED modules and projectors remain heavily imported, leaving margins vulnerable to rupee depreciation. And related party opacity. It's LS Lumax, the Hyundai Kia joint venture, did 2,160 crores in 9 months revenue. Significant value sits in these JBs, which can sometimes complicate the standalone narrative. Currency volatility is a margin killer here. Until they localize their LED modules, Lumax is effectively a high-tech assembly house with high foreign exposure, foreign currency exposure. So what are its key strengths? If you ask, I'll say 81% LED order book, which shows margin expansion bridge, and 40-year Stanley JV technical fortress, and 100% SMT localization achieved. Coming to weaknesses, heavy import content, nearly 65 to 70% in electronics, Maruti concentration, which nearly takes 33% of orders, and two-wheelers, main lighting, still halogen heavy, which is a value cap. And coming to opportunities, its tech roadmap, which is 20,000 pixel ADB modules, preloaded capex for Bengaluru plant, and expansion into high margin road projections are some of its opportunities. Coming to threats for Lumax in Lumax Industries, technology obsolescence if localization lags, currency volatility, I mean to say rupee depreciation, and cyclical slowdown in passenger vehicle volumes could be a serious threat for Lumax Industries. So we need to track whether they can hold more than 9.5% EBITDA without tooling windfalls is one which we need to watch out for, and whether the Bengaluru SOP will commission in Q4 fiscal year 2027 for Toyota and Maruti plant is need to be tracked out, and its localization progress also we need to check whether they are moving in the 30 to 35% electronics localization figure or not, and SL Lumax growth monitoring the Pune's facility ramp up, which is operational since October 2025 alone, and its tech adoption. Transitioning of two-wheeler main lighting from halogen to LED is a thing which you need to watch out for. And it also received the company's Chakan 2 facility also receives 59th conference award in February 2026. And there is also a leadership change, superannuation of Alok Verma, who is a senior vice president, effective November 30, 2025. So these are some leadership changes also happened. So if you like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.